It's time now for Mortgage Matters with your host, Bill Sandvig. Bill Sandvig serves as market leader, running the South Carolina coast for Movement Mortgage. Movement finished 2014 ranked as the #1 mortgage company in purchase mortgages for the Charleston Tri-County area. And they're still growing. And now your host of Mortgage Matters, Bill Sandvig.
Hello, Charleston. Welcome to the next installment of Mortgage Matters. I'm so pleased to have you on the air listening to us today. Got a great show. We're going to talk about some really key things that are going on in the mortgage industry. We're going to talk about one of the things that's really near and dear to my heart, a very common question, involves a lot of my time, a lot of my team's time, and that's about building credit. A lot of people come to me and they want to know, what do I need to do to get myself in a position to be able to buy a house? And, that's one of the things I really love about the industry is taking a first-time home buyer, someone who never imagined that they could even be a homeowner, and coaching them through the steps. And so many times these people are surprised at how little it takes to get in position to be able to buy a house. So we're going to talk about building credit, building your credit. And then we're going to talk about mortgage heartbreakers. There are so many times where a client comes to me and they share a story with me that I just cannot believe took place. I can't believe the situation that they found themselves in, or I can't believe the terrible advice that they received from other companies or from other lenders in their past mortgages. From there, we're going to go into a conversation that everybody has when they're thinking about a mortgage. Should we do an ARM and have an adjustable rate mortgage, or should we do a fixed rate mortgage? A conversation that a lot of people just tend to just instantly gravitate to that 30-year mortgage. And there are definitely situations where at least the conversation needs to take place. Should I be thinking about doing an ARM loan? So I'm going to talk about some of the stigmas and some of the things that, might be out there thinking, I really don't want to do an ARM loan. I just want to talk about a 30-year fix. Well, that's not necessarily in the best interest of your financial future and your family's future or for your mortgage. So, I'm really glad to be back on the air here on 1250 WTMA, The Big Talker. Again, I'm Bill Sandvig. You can reach me anytime. 843-300-7870. That's my cell phone. Please give me a call. I'll be happy to talk about just about anything. I like to talk about mortgage. I like to talk about finances, but we don't have to stop there. We can talk about your kids, talk about your family, talk about where you're going with your financial future. We can talk about the weather. If you want to talk about the weather, I'm happy to. So, please give me a call, 843-300-7870, or you can go to my website, www.lowcountrylending.com. You can go online, click apply, do a free buying power evaluation in very little time. No cost to you. I'll be able to tell you what you qualify for, what programs are out there to help you get into your new home, what options you have. You're gonna be surprised at how little you might need to put down or how much you can actually qualify for, and stop renting and get into a house. Interest rates are down, interest rates are low. Now is the time to take that step. And with housing prices going up and rising, you'll never, probably in the history of your life, be able to get into as much house today as you'll be able to sometime in the future. So buy now, go online, do the buying power evaluation at www.lowcountrylending.com, and I'll be happy to reach out and talk with you. Please, we are live here today in the studio. If you've got any questions for me you want to talk about on the air, talk about your specific situation, or dispel some rumors you might heard about what's going on in the lending or the real estate world, please call in to the studio, 843-556-1250. Okay, let's get right into the first topic of conversation, and that is building credit. This is probably one of the most common things that I deal with new emerging first-time home buyers, and they're reaching out, not sure where they stand, not sure what they can afford or what they can buy. And my advice to all people out there, whether you're a first-time home buyer or whether you're thinking about moving in a year, or if you just really want to know where you stand, maybe you're not even thinking about moving, you just want to know what your options are, plan ahead. Plan ahead, reach out to a professional early, someone local who knows the local market, who can help you through this giant transaction that you're considering going into, and plan ahead. Because I'll tell you, I always tell people, I can't fix income. I can't get you a job. I can't fix your income. Your income is what it is, but I can help you fix your credit. And you might be surprised that you're not as far off from being able to buy as you might think. A lot of people talk about, well, I have really bad credit. I've made some mistakes. I got overwhelmed. I lost a job, had a drop in income. My credit is really bad. There's no way I'll be able to buy a house. What I tell people is I can fix your credit. All it is a matter of time. It's not a matter of if you can buy a home. It's a matter of when you can buy a home. A lot of people are confused about if you are ranking credit, what is better, to have no credit or to have bad credit? Believe it or not, it is worse to have no credit, to have no credit lines, no credit history, because you can't get a mortgage if you've got no credit history. You have to establish credit history in order to get the premium interest rates, in order to be available to all the variety of mortgage products that are out there. So my first piece of advice for credit is you got to go out and get some. You need to go out. If you don't have credit, if you don't have a credit card, if you don't have any installment loans in your history because you have done such a great job avoiding those items, living within your means, I commend you because you are in a position to have an excellent credit score and to have an excellent credit score very fast. You need to go right now and open up 2 secured credit cards. Maybe you can apply for a regular credit card. You might need to do a secured card. But a lot of times, if you don't have any credit history, the credit card company is going to want you to do what's called a secured credit card. It does not have to be a big credit line. You go out, you put $200, $300, $400 down, and they give you a credit line. Sometimes they'll give you dollar for dollar what your credit line is. Sometimes they'll give you more of a credit line than you put down. But this is called a secured credit card. You need to go out, if you don't have any credit, and get 2. The goal here is at the end of the credit building, you're going to have 3 active trade lines between installment debts like a car loan or a personal loan, or maybe you bought a jet ski, and credit cards, or what we call revolving debt. You need to get 3 active trade lines. So 2 of these, I recommend going and getting secured cards. Now, once you've gotten these secured cards, you need to start using them. A lot of people will have credit cards in their credit history, but they haven't used them in 10 years. They're just sitting there doing nothing. Maybe once a year you pay off the month annual fee if there is one, but you need to get in the habit of using these 2 cards. When I was coaching my oldest daughter, when we're talking about credit, we're actually going to go and get 2 secured credit cards for her. And we're going to have a red card and a blue card. And the 2 cards, she's going to get in the habit of going once a month and paying for a tank of gas with one of those cards. The next time she goes and gets gas, she's going to use the other card to pay for a tank of gas. As soon as that bill comes, we're going to pay it off in full. So she's using the credit and she's using it responsibly. And every month she's paying it off. You're going to get gas. You're paying for cash right now anyways. So you just got to retrain yourself to just use that credit card one time. Now, an important factor here, when you have these credit cards with these small limits, do not get in the habit of going, if you have a $400 limit, and buying $420 worth of groceries. The card will let you do it. They'll let you overdraw. But when you're overdrawn on a credit card, it really hammers your credit score. Ideally, you do not want to let your credit balance go above 25% of your available balance. That's why I love the tank of gas conversation. If you've got a $300 credit limit, you go out and pay for that tank of gas, you're showing that you're using the card. It's probably not going to be more than $50 or $60 at tops. And when you pay that card off, you're showing the creditors, you're showing the credit bureaus that you not only have credit, but you know how to use it responsibly. So use your cards, pay it off in full. If you have a car and you own it outright because you paid cash for it, I'm assuming you're out there and you have an automobile. Well, if you did an amazing thing and went and paid cash and you avoided any financing, I want you to actually go and refinance that car and take out a small car loan. You can stretch it out over a course of a couple years. You don't need to take a big loan out. It can just be a couple $1,000s, whatever you're comfortable with. And maybe you get a $2,500 loan. You've now got cash that you can just put in the bank, set it aside for your down payment of your future house. You just set that money aside, and now you're going to make small, timely payments on your new car loan. It might only be $50 a month, $60 a month. Why do I want it to be small? Because I don't want your new car payment or your new credit card payments to bite into your buying power for your new home that you're planning for. Your payments are going to be very, very small, very, very modest, and these payments aren't going to dramatically impact the size house that you can buy and the size house you can qualify for. But what have we done now? We've established 3 trade lines. As you make these payments, within a year's time, it is expected, if you have no other derogatory credit, that your credit score should be pushing in the 700s almost immediately. You're going to start that credit and establish that credit in a positive manner right off the bat. This is so important and so crucial because when we go to make this purchase, you've already set aside some money. You're saving a little bit at a time to go make this purchase and putting aside for your down payment. And you don't need a significant down payment. You're going to be able to get into a conventional loan with only putting 5% down, as little as 5% down. And that means over the course of a year, while we're building your credit, all you had to do was save $500 or $600 a month. And we put you in perfect position to put money down on a $200,000 house that's going to equate to less than a $1,200 payment. And I bet you're out there right now, if you're renting a 3-bedroom apartment, you're probably spending $1,200 a month in rent. This is all about planning ahead. You've got to plan ahead. You've got to reach out to someone like me. You got to give me a call at 843-300-7870 so I can coach you through this stuff. When you plan ahead, anything is possible. Anything is possible in the mortgage industry, in this real estate market. You can buy multi-unit homes for $400,000 and still only be making $30,000 a year. I can help you plan for that kind of stuff. Help you start building a real estate portfolio if that's what you want to do. Get your family out of renting and start investing in yourself, investing in the equity in your home. Watch, we're in a healthy market right now, folks, in this Tri-County area. Property values are going up. You should be out there taking advantage of it. And it's all going to start with talking to someone early, talking to them and letting them help you plan for this purchase. Plan ahead. Reach out early. I can't stress that enough. So let's go over that again. What do you need to do to start building that credit and building it fast? You got to establish 3 trade lines. The requirements for a conventional loan, we're going to try and keep you away from that FHA loan that has some additional higher fees. To get a conventional loan, you've got to have 3 trade lines with a history of 12 months. There are some exceptions where we can get around that. You know, if you've got 2 and some change, we might be able to pull that off. But if you've got 3 active trade lines for 12 months, you're hitting a home run. We can get you into that conventional loan, and your credit is going to be established, and it's going to be growing, and it's going to be healthy and growing strong. I recommend going out and getting those secured cards. If you don't have any credit history, this is great advice if you're listening out there for your children, or maybe your grandchildren are coming of that age where they're 18 years old, and it's time now. Don't wait. It is time right now on their 18th birthday to go out and start establishing credit for them. You can build their credit and make a difference in their future for the positive by the time they're out of college, by the time they're ready to go and get their own cell phone bill and their own power bill. They don't have to put down security deposits because their credit score is over $700. Think about all the impacts, the positive financial impacts that you can have on your children and your grandchildren because you had this conversation. Guys, I can't stress how important it is. Please call me, 843-300-7870. That's my cell phone. We are live here in the studio at 1250 WTMA, the Big Talker, so please call in, 843-556-1250. When we come back, we're going to go over some stories that I got to share about mortgage heartbreakers, some things that pull at my heartstrings about bad advice that I've heard from other mortgage companies, bad experiences that some of my clients have had. And, we're here right now. It's Mortgage Matters. Stay right there.
There's more Mortgage Matters with Bill Sandvig coming up next on the Big Talker, 1250 WTMA. WTMA. You're listening to Mortgage Matters on 1250 WTMA. Once again, here's Movement Mortgage's Bill Sandvig.
We just spent the last 15 minutes talking about how you can get yourself in position to make a mortgage purchase by planning ahead, reaching out to someone local, and start establishing your credit, and talking about how to build your credit and how to get you from being no credit or bad credit into good credit as quickly as possible. I do a lot of this with a lot of clients, and so many people are shocked at how little money it's going to take and how few things they need to do to get out of what felt like a very desperate situation where they thought that they were going to be renting for the rest of their lives. And I can coach you through what things on your credit report have to be dealt with right away, what things on your credit report don't have to be dealt with right away, and what things on your credit report never have to be dealt with, where we can get you into a place where you can buy a house. Because I promise you, buying a house, living the American dream, it's not a matter of if, it's a matter of when. And if you are out there and you are committed to getting you and your family into a house, then I am going to be committed right there with you. I will be there with you every step of the way to get you into your home, to get you into your next home, and and give your family financial security through building equity in a home and investing in yourselves. So we talked a lot about building credit. I'm going to quickly go over the quick highlights. And the quickest thing I can say is if you don't have credit, you've got to establish credit. If you have credit and it's bad, you got to reach out to me so I can coach you through it. You don't need to go out to a third-party credit recovery agency. Come to me first. Come to me first because you're going to be surprised at how little you have to do in order to get in position to get into your next home. Please, we are live. Call in to the radio, 843-556-1250. Call in. We'll talk about any questions you might have. I'll be happy to address any situation you might have had. Maybe you've got a story to share about your real estate experience or a mortgage experience you've had in the last couple of years. I know there's a lot of horror stories out there. I know there's a lot of situations that people are missing closing. So I'd love to talk to you. And if not, you can call me offline anytime, 843-300-7870. That's my cell phone. We can talk offline and see how I can help you meet your family's goals and your family's real estate goals. And I can't stress enough, I talk about this a lot, when you are living in the Tri-County area or anywhere in the country, you have got to find a local team member, a local partner who can help you through this transaction. If you call me and it's not something I can help you with, I have got plenty of local partners that I can put you in touch with. I've already done all the work. I know who the top professionals are in our market. I work with them all the time. People like Jimmy Foti, owner of Foti Law. You can find his company at FotiLawFirm.com. Jimmy does an amazing job. Such dedication to his customers and to his clients. Another fine example of a local talent, a strong company for property and casualty homeowners insurance. Andrew Muller, president and owner of Mappus Insurance, a local insurance company here downtown. This guy knows more about flood insurance than anyone I've ever met. If you got a question about flood insurance, which is very specific to our local market, you have got to give me a call so I can put you in touch with him, or you can go directly to his website at www.mappusinsurance.com. Of course, if you need to talk to me, again, my cell phone, 843-300-7870, and you can find me on my website at www.lowcountrylending.com. I want to talk a little bit about mortgage, what I'm calling mortgage heartbreakers. Every so often, way more regularly than I like to have happen, a client comes up that's maybe doing a refinance or they're about to buy their next home, and we kind of talk through their real estate history and their mortgage history, and they share with me what another company or another loan officer advised or didn't advise them to do, putting them in really not the best situation for them, costing them thousands upon thousands of dollars in that real estate transaction just because they didn't end up working with a partner who was really looking out for their best interest, or maybe their partner wasn't experienced enough to recognize and identify the programs that were best fit for that particular customer situation. The first one I want to talk about, and the most common one, maybe not the most common, but the first one I want to talk about is lender-paid mortgage insurance. I hear so many other companies talking about lender-paid mortgage insurance and what an advantage it can be, and I'm just not sold. I feel like lender-paid mortgage insurance is trading a short-term gain for a long-term cost. Lender-paid mortgage insurance basically allows for you to not pay mortgage insurance if you're putting down less than 20% in exchange for a higher interest rate. Here's why I don't think that's a good idea. If you were, I always like to use a $200,000 loan example. If you're going to get a $200,000 loan and you've got good credit, but you're only putting down 5%, you are going to have mortgage insurance. Either it's going to be paid upfront in one flat fee, or it's going to be paid monthly until you reach 20% equity, or it's going to be paid by the lender in exchange for a higher interest rate. In this situation, good credit, $200,000 loan, 5% down, the mortgage insurance would be somewhere around $90 a month. $90 a month tacked on to your total payment for mortgage insurance. Well, what a lot of people don't talk about is after you have 20% equity in your house, or 2 years have passed, whichever is longer, so you can't get rid of mortgage insurance faster than 2 years, that mortgage insurance is eligible to drop off after you have 20% equity. So let's take this scenario. If your house was to appreciate in value only 3% a year, and you were to make just minimum payments on time over the first 3 years, by only putting 5% down, 3 years later, you're going to be eligible to have 20% equity in your house because of the 3% increase in value. All you need to do is call up, get an appraisal, and likely your house is going to have enough value in it, enough equity in it that you can drop your mortgage insurance in 3 years. 3 years times $90 a month, we're at almost exactly $3,000 for the entire 3 years. Now, so you spent $3,000, but now we need to compare that to the lender-paid mortgage insurance situation. When you do lender-paid mortgage insurance, your interest rate is going to be higher. The interest rate for this scenario would be about 0.3% higher. That would be $45 higher than if you just went with the base bottom rate and did mortgage insurance. So now the difference between lender-paid mortgage insurance or just paying your own mortgage insurance, it's only $45 a month different. You're only saving $45 a month by taking the lender-paid mortgage insurance. But what have you done? You've traded something temporary, the mortgage insurance, for something that's permanent, the interest rate. The interest rate is forever. It doesn't go away. So when you would have been eligible for your payment to improve by $90 a month with the mortgage insurance scenario, you're going to have that higher payment for the rest of the mortgage with that higher interest rate, unless you spend money in a refinance. When I hear this advice, my skin crawls, and I'm just like, you have not been educated properly. Let's have a conversation about this, and let's make a decision. Maybe you are going to sell your house in 3 years, and you know it for a fact, and that's the right scenario for you. But man, for the most part, for most scenarios, especially in our market where housing values are going up, last year housing prices went up 10%. If you only put 5% down on your house, you'd already be eligible as soon as that 2-year hit to get rid of your mortgage insurance. This next one breaks my heart. As a former active duty naval officer, I hate hearing when my peers and my veterans have not been put into a VA loan when they have eligibility. And instead, they're placed into an FHA loan because maybe that lender wasn't familiar with VA loans, or they were scared of VA loans, or they just didn't want to do a VA loan because they hadn't done a lot of them before. This makes me not only upset, it makes me mad. Because this VA loan, and it might not be the right choice for you. Maybe you're putting down a lot of money. Just because you're a veteran doesn't mean you have to do a VA loan. But man, 99% of the time, the VA loan is the right product, especially over an FHA loan. An FHA loan compared to a VA loan for someone with the same credit, buying a $200,000 loan, the FHA payment is going to be $135 more than the VA loan. The interest rate is going to be the same. The payment is going to be $135 more a month because they put them in an FHA loan over a VA loan. Why is this happening? Why does this come across my desk once a month? Why are people out there? Why are there lenders out there not taking care of our veterans, not looking out for their best interest, and at least having a conversation? I have had so many times where people that I've worked with in the past, people that I've served with, have called me and to talk about refinancing their mortgage. And instead of talking about a VA loan, we're talking about an FHA loan. And I can't believe it. I say, what happened here? How come you didn't do a VA loan? And they say, oh, the bank never told me about the VA loan product. I didn't know that I was eligible for it, or I didn't really know how it worked. They never mentioned it. And my patriots, my peers, my veterans, people that I've served with have spent thousands and thousands of dollars more on their FHA loans than they would have in a VA loan. The fact that this happens ever actually disgusts me. I am very familiar with VA loans. I served in the armed forces. I was a naval submarine officer. I know the VA product like the back of my hand. I love doing VA loans. They don't scare me. I think they're simpler than other loans. I've done so many of them. So please, call me. If you're a veteran out there, I want to serve you. If you know someone who is a veteran out there, have them call me. I want to serve them. VA loans are so powerful. You need no down payment. You need the very high qualifying ratios. If you're a veteran, it is very, very highly likely that I can get you into a house right now. And if your credit is really ugly, I can probably fix it in just a couple months and get you into that house. The last thing that breaks my heart is the ARM versus fixed rate conversation. I don't think a lot of people out there are having this conversation. And a lot of people end up in maybe fixed rate products when they should have been in ARMs, or ARMs when they're talking about fixed rate. We're going to really roll into that and expand into that discussion in our third segment. So if you're out there listening, please call in 843-556-1250. I'm Bill Sandvig. This is Mortgage Matters on 1250 WTMA, the Big Talker. I'm really excited to share with you some of the points about ARM loans, and variable rate loans versus fixed loans, so we can kind of talk through some things that might apply to you. Again, this is Bill Sandvig on Mortgage Matters, and we will be right back.
Bill Sandvig has more Mortgage Matters straight ahead on 1250 WTMA, the Big Talker.
1250 WTMA.
This is Mortgage Matters on 1250 WTMA. From Movement Mortgage, here's Bill Sandvig.
I'm Bill Sandvig. You're listening to Mortgage Matters here on 1250 WTMA, the Big Talker. We're live in the studio. Please call in 843-556-1250. I am happy to talk about anything mortgages, anything finance, or anything at all. So please call in. I'll be happy to talk to you, and we'll talk through whatever's going on in your life and maybe what you're planning for in your real estate transaction or what's coming up for your mortgage needs, and we'll share it with Charleston. So please call in. The last two segments, we talked about credit building, things and advice you can give to maybe your kids or grandchildren about how to start establishing credit and all the positive implications that establishing good credit can have in your life or in your family's life, and how to establish that credit and how to do it smart and wise and to get that credit score up as quickly as you can. The second segment, the thing I want to talk about again out of that second segment is we talked about heartbreakers, things that I've seen that other companies have done or less experienced loan originators have done to clients. And the one that really pulls on my heartstring the most is when I see a veteran not placed in a VA loan when it clearly would have been in their best interest, and instead they're put in a government FHA loan, a higher cost loan, a higher dollar transaction loan, costing people literally thousands upon thousands of dollars in their home ownership. And man, that just breaks my heart to see people that I've served with and people that have committed their lives to our country not getting the proper advice and the proper service that they need. So I got to stress, if you or anyone you know is thinking about buying a house, have them reach out to me. I've got a full team of people that are here to serve you. And I know the VA process as a former veteran myself, as a former naval officer. I know it like the back of my hand. VA loans, FHA loans, I promise you, I'm going to spend the time with you to educate your family member on what products are out there for them and coach them and help them to make a decision for themselves about what's best for their family's future. So please reach out to me. My website, www.lowcountrylending.com. My cell phone, 843-300-7870. You can go online and fill out a free buying power evaluation. I'll be able to quickly identify what programs are available for you, be able to talk through what your buying power is, what size home, what purchase price can you afford to get into, where's your budget fit. Maybe you've got a payment in mind that you want to make and you don't want to go over that budget. I can tell you exactly what that payment correlates to in purchase price and help you work through that process and help you hone in your search. If you're thinking about buying, if you don't have a real estate agent, I can help you there too. I've got plenty of local partners that'll know your needs, know your market, know where you're looking to move into the community, specialists that know your local area that can do incredible things for you, help represent you, negotiate on your behalf, and do an amazing job to get you into your home, get you into your next home. And that's what we're here for. So please call anytime, 843-300-7870. I want to talk a little bit about one of the heartbreakers or one of the conversations that I don't think enough people are having, and that's an ARM or adjustable rate mortgage versus a fixed product. There's the 30-year fixed, 15-year fixed, and then there's the adjustable rate mortgages, which have a fixed period typically of 5, 7, or 10 years, where your interest rate is lower than what that 30-year fix would be, but it's fixed for 7, 10, or 5 years. Now, most people default to the conservative 30-year mortgage. And I'm telling you, now more than ever, with interest rates so low, that is a really good conversation to have. And I'm sliding towards encouraging 30-year fixed mortgages more than I ever have before in the past. If you look over the last 30 years in the mortgage industry, we have been in a overall decreasing interest rate market. If you remember back into the 80s where interest rates were in the 16th, the high teens, and then people were able to refinance into the low teens, and then, my gosh, the first time ever mortgage rates went into the single digits and everybody was raising their hands, and we'll never see rates this low. And then they kept ticking down over the course of time to where they bottomed out in the last couple of years, where we've seen interest rates at 4% or even a little bit lower than 4% for a number of years. And I'm telling you, there's nowhere else for them to go. We know that they can't get any lower because the government's been holding those rates down for so long that now is the time. Interest rates are not going to go any lower. And so it's conceivable to think that over the next 30 years, it's reasonable that we'll be in a rising interest rate market. At the very, very best, we're going to be at a flat rate market, which I don't see happening. I do see it ticking up over time. Are we going to go back to 14, 15, 18% rates? I don't know. It's possible. Inflation could happen. History repeats itself. But it's more likely that we're going to be in a rising interest rate market. So the 30-year fixed has a stronger argument than ever, in my opinion. But you've got to have that ARM, adjustable rate mortgage versus fixed conversation. Here's a couple of situations where I think that situation and conversation should really be happening. Are you heading into retirement? Are you at the age where you're maybe refinancing or your income is about to change and you're probably not going to be in this house for that much longer? The conversation needs to be had. Where do we see ourselves if we head into retirement? Are we going to be in this house for another 30 years? Does another 30-year mortgage really make sense? Another situation. Are you over the age of 70? I've had this conversation many times with customers where, elderly people are coming to refinance their home, lower their overall payments, or to get cash out, or to minimize their payments, and they go right to the default 30-year mortgage. And I'm thinking to myself, this couple who's in their mid-70s, we're going to do a 30-year mortgage, and they're going to spend more money now. They're going to have less disposable income now because the interest rate's going to be higher, so that they can possibly save money on the back half of the mortgage when they're going to be 95 to 105 in those last 10 years. Does that really make a lot of sense? I mean, sure, it's possible, but probably very few people are going to be still living on their own in their own home with that mortgage past the age of 90 or 95. Does it happen? Yes. Do I think we should plan for that and play conservative for that? No. I think we should get that payment as low as possible now so they can save money and have that extra disposable income for other things and enjoy the quality of life now. And that would be doing an ARM loan where the interest rate is lower and the payments are lower. Are you a young family moving into your first home, moving into your starter home? Are you a family that has your family size changing? Are you expecting to grow and to add children? Are you in a place where you're thinking about having kids? You've just, you're going to add people to that household and you're going to quickly outgrow this house. Are you about to become an empty nester? Maybe people are looking at moving out and downsizing is in your future. If you're thinking about holding on to this house because your interest rate is going to be so low and you can fix it for 30 years and you really have that plan to have a rental property and to keep that property and rent it out, then by all means, do not even think about an ARM loan because no one is going to be able to get 4% in 5 years when you got ready to move out of this place. And it's going to be very enticing to want to rent that out because rents are so strong and rates are going to be higher and you're going to have probably pretty good margin on that property. But if that's not you, if that's not in the back of your mind, you really need to be thinking about an ARM loan. Let me go over really quick the difference of what a $200,000 loan with a 30-year mortgage compared to a 7/1 ARM where that interest rate is fixed for 7 years. I'm not going to go into specifics of rate, but the difference typically between a 30-year fix and a 7/1 ARM is about 0.75% in interest rate. So if the difference is somewhere around 0.75%, give or take, that would be the equivalent of $90 a month in payment on a $200,000 loan. So your required payment is going to be $90,000 less with a 7/1 ARM than it would be with a 30-year fixed. Well, if you're thinking about doing a 30-year fixed, let's talk about what if you committed to that 30-year fixed payment on the required lower payment of the 7/1 ARM. Well, at the end of 7 years, if you'd been making the 30-year payment on the 7/1 ARM, you would have put $12,000 of additional equity into your house. You would have $12,000 more in your pocket when you go to sell that house in the 7th year, just because you took a 7/1 ARM and you made a 30-year fixed payment. Let me say that one more time. You take a 7/1 ARM that has a lower interest rate, but you make the payment that you would have had if you'd gotten a 30-year fixed with a higher interest rate. At the end of 7 years, on a $200,000 loan, you've got an additional $12,000 of equity in your pocket. Now, here's the final stat I want to leave you with in this segment. 58% of Americans do not stay in their house longer than 10 years. That house is gone. They no longer own it in 10 years. That doesn't even account for all the refinances, the cash out refinances, the different things they might have done to get rid of that loan that they were fixing in for 30 years. 46% of Americans are not in the same house, do not own that house 8 years later. So half of the time, America is never getting to the place where they would have been starting to recoup the money they were trying to save in that 30-year mortgage. Half of the time. That gives me pause. That gives me thought about, maybe I want to talk about doing an ARM. Maybe an ARM isn't all that bad. You know, when we come back, we're going to talk about Movement Mortgage and the value proposition that Movement Mortgage has for you when you go out to find your house. We're going to put you in a strong position to make an offer on that house and why Movement can get you there like no other company can. You've been listening to Mortgage Matters. This is Bill Sandvig on 1250 WTMA, the Big Talker. Please call into the studio. We are live, 843-556-1250, and we will be right back.
Mortgage Matters continues next on Charleston's Big Talker, WTMA.
WTMA.
Now, let's get back to Mortgage Matters on the Big Talker. From Movement Mortgage, here's Bill Sandvig.
I'm Bill Sandvig. This is Mortgage Matters, and we are going to finish this show out strong. We talked a little bit in the last segment about ARM versus fixed rates, and, there's a real conversation to be had for ARMs, but I'm ready to move on. I'm ready to talk about what I am most passionate about, what I love talking about. I'm going to talk about Movement Mortgage. You are out there, and you've just gone through the mortgage experience, and you bought a house in the last couple of years, and you're thinking back, and you're thinking about how painful that process was, and how that company had to collect document from you after document after document, right up all the way until closing, and it was a painful experience. Well, I'm here to tell you that it doesn't have to be painful. It doesn't have to be like that. At Movement Mortgage, what we're going to do for you, if you're ready to go thinking about buying a house, you need to give me a call at 843-300-7870 so I can get you a buying power evaluation free, and we can start this mortgage process out right. Every other bank, when you maybe reached out to your real estate agent or you knew that you were ready to go buy a house, you went and got what's called a pre-qualification letter. A pre-qualification letter from a lender where they did a cursory check of maybe your income and asset documentation. Maybe they didn't. Maybe all they did was pull your credit and have a conversation with you. Maybe all they did was have a conversation with you. A pre-qualification letter from a lender does not go through underwriting, and it's really only worth the paper that it's written on. It takes me less than 7 seconds to make a pre-qualification letter. All I got to do is take a form letter, change a name, change an address, change a phone number, and change a purchase price. And all of a sudden, I could print, and you got a pre-qualification letter. That is the reason that so many transactions have trouble right up to the last second. That is the reason that these deals and these horror stories fall through, where I was trying to sell my house, and the buyer who had told me that they were pre-qualified, in the 30th day of a 31-day closing, told me they couldn't get a loan. And we were supposed to go move into our house 2 days later. And we needed the money from the sale of that house to move into our house. Now what do? Our life's in boxes. It's because you didn't use a company like Movement Mortgage. Here is what we're going to do for you. When you call us, we're going to start the process now. We don't need a property address. All we need is you and your commitment. You're going to come in. We're going to take all of your income and asset documentation. We're going to send that product into underwriting and issue you an approval, a commitment to lend on you. When we put you into underwriting, the underwriters are going to devote their time and energy to you, even though you don't have a house yet. and get you approved so that when you're ready to go out and make an offer on that house, you're in a position to make a strong, powerful, negotiating offer on your next house. It cannot be stopped. We're going to make you look like cash because you're through underwriting. We're the only company that does this. Everyone else is worried about having a sales contract or focusing on the refinances that they have. They're overwhelmed with what they've got going on. Movement Mortgage has devoted the additional time, money, and man hours to get you in a position to make a powerful offer. I want you to think about this. If you're selling your house and you get two offers, because, man, we are in a hot market right now. It is multiple offers all over the place. It is a seller's market without question. And you're selling your house and two offers come in. And one is a commitment letter that says that they can close on your house in 2 weeks. 2 weeks, and a commitment letter has been issued before you even saw a contract, and the commitment letter says that this potential buyer has been approved through underwriting. All the hard work is done, and all they got to do is do an appraisal, get the title work done, and do an inspection on your house, and they're ready to close. You have another offer that's a pre-qualification letter, and it says just that. This is a cursory check of the potential buyer, and somewhere on that pre-qualification letter, it says, this is not approval for a loan. Every single lender out there on their pre-qualification letter says, this is not approval for a loan, and it says it somewhere in bold. So you've got these two choices. One says approved and it's a commitment. The other one says that it is a pre-qualification letter. Now, when this happens, you're going to take that 2-week closing over that 45-day closing with a pre-qualification letter every single time. You might have to make 2 less mortgage payments. So think back. We're going to put you in a position as a buyer to close fast, to do the hard work up front, have a stress-free transaction, and when that happens, everybody wins. You can even negotiate possibly a cheaper price on that house. Think about it. All the banks are slowing down. They're getting slower and slower. I'm hearing about 50-day closings. I'm hearing about 60-day closings. I've even heard horror stories where a bank set the expectation that you can't close on your house for 75 days. How can you possibly be competitive as a consumer with a cash offer when that cash offer can close in 2 weeks when you're saying you can't close for 75? You can't be competitive. That house you fell in love with, you're not going to get it. The house you want to put your family in, it's not going to be yours. Because you can't be competitive. Movement Mortgage is going to make you competitive. We're going to do all the hard work first. And we can do it so fast. You get us the documents that my team and I ask of you, and in 6 business hours, our underwriters are expected to review and make a decision on your file. That's 6 business hours. Not 2 weeks like our competition, not 3 weeks like our competition. In 6 business hours, that's the expectation. You get me your stuff on a Tuesday. By Wednesday, I've got it turned in. By Thursday, you've got an approval and a commitment letter in your hands. And Friday and Saturday, you're out looking for a house, making a competitive offer, heads and shoulders above your peers and heads and shoulders above the rest of the offers that are out there. We're going to make an offer that says you can close in 2 weeks, 3 weeks. Hey, the seller might not need to close that fast. They might need 30 days. They might need 40 days, but they're going to take your offer because you put your best foot forward and you showed that you did the hard work. You got a commitment letter, and we're going to get you the house that you want at the price that you want. Don't wait on this stuff. Call me now. Call me early. Reach out to me at 843-556-1250. That's our number here in the studio, 843-556-1250. And you can call my cell phone anytime, 843-300-7870. You can go to my website at www.lowcountrylending.com, put in a free buying power evaluation. We're going to put you through this process where we collect all of your documentation up front, get you fully approved, so that when you go make that offer on that house that you fall in love with, you are putting your best foot forward. You're making a strong offer. I have seen countless clients get better deals, win out when their offer was less than the other offer next to them because they were in a position where there was no doubt. I mean, think about it. If we can close in 2 weeks and the other offer can't close for 60 days, that could literally be 3 mortgage payments for that seller. 3 mortgage payments could be $6,000. You have a $6,000 edge over the competition because you called Movement Mortgage, because you called me. Man, I'm so happy you tuned in today. This is Mortgage Matters. I'm Bill Sandvig. We're going to have another great show next week. And just before I go, I want to say congratulations to my oldest daughter, Sarah. You graduated from Wando. You're a star, and I love you. We'll see you next week.
been listening to Mortgage Matters with Bill Sandvig from Movement Mortgage. Call Bill for your mortgage needs at 843-300-7870. That's 843-300-7870. Listen again next week at this time for another edition of Mortgage Matters with Bill Sandvig on 1250 WTMA.